Hello traders and welcome to yet another session for 2025 mentorship. And today I just want us to simplify the supply and demand strategy. And we will dwell basically on trying to identify supply and demand zones. So the key goal is for you to be in a position to be able to draw these supply and demand zones, and also being in a position whereby you can be able to trade them comfortably. So when we talk about demand and supply, it is a very core concept in price action trading. And the supply and demand zones represent institutional buys and buying and selling areas. And therefore, it is important for you to understand them as a retail trader. It is important for you to comprehend them so that you can improve your entry accuracy, also that you can start thinking like the institutional traders. So you will understand that this strategy will basically help traders in terms of identifying price zones where most of the institutional activity is likely to occur. And therefore, it will help in terms of revealing potential areas of strong reversals, breakouts, or trend continuation. So these supply and demand zones, they represent imbalances, whether either maybe probably for instance, where either supply exceeds demand, leading to drop in prices, or demand exceeds supply, which leads to a price increase. So this strategy is very important because, like I said, it gives you the institutional insights, how big institutions like the banks, like the hedge funds, leave footprints at the key supply and demand zones, and therefore trading these zones let you follow the smart money. It will also be in a position to give you what we call precision entries. So traders can enter with tighter stop losses and clear take profits by targeting reaction zones rather than chasing the price. And in terms of risk to reward ratio, supply and demand will give you well-defined zones that allow asymmetric setups where your potential reward is often 2 times, 4 times. Sometimes you can get even up to 8 and even more, depending on now which time frame you are looking at for your analysis. So it is a strategy that is universal because it works on all time frames and markets. You can use it in trading Forex, you can use it in stocks, you can use it in crypto, you can use it in commodities. And it has an objective framework, unlike some strategies based on indicators that lag behind. Supply and demand trading is rooted in price action and real market dynamics. I know I usually trade the ICT, but before I shifted to the ICT, I used to do the supply and demand, and it was quite a good strategy. Even sometimes I can even sometimes even right now I can utilize this concept of supply and demand basically to trade them because they are related, very closely related to the ICT concept, especially the order blocks, only that now the entry rules are a bit different. Okay. So when we talk about a supply zone is an area where selling pressure exceeds demand and usually forms after a strong move down. Okay. So you find, so I'm just going to scribble here. So you find that the price was pushing up, then it reaches a point, and then it pushes on the downside. So this point, before it pushed on the downside, this level here, before the strong move on the downside is what we are calling a supply zone. Okay, so these are supply zone. So you find that price will often retrace back to these zones or revisit these zones, and once the price does that, then we will be eyeing for selling opportunity for the price to continue pushing on the downside. So as you can see, it's quite related to the ICT concept because sometimes these supply zones can be, in terms of ICT, can be what you're calling the bearish order blocks. Okay, so when you talk about a demand zone as well, this is an area where buying pressure exceeds supply. Typically, it forms before a strong move up. price often bounces when revisiting this level. So this is what we are talking about. Okay, so price is pushing in the downside, it's pushing on the downside, then it reaches a level whereby it starts to push up. Okay, so at the bottom here, before it started pushing up, this is where we have now the demand zone. So we want to see the price revisit this zone here, the demand zone, and then now we will be eyeing some buying opportunity for the price to continue pushing on the upper direction. As simple as that. As you can see, this is also related to what we call in ICT. In terms of ICT, it is related to the bullish order blocks. Okay. But now the rules of entry, like I said, they're the ones that differ slightly, and I am going to expound that even as we push on. So, after understanding the demand zones and the supply zones, the key issue is now how to identify them, okay, in the charts. So, when we go to the charts, because we'll go there in a few, what you're going to look at is for strong move, right? Or what you call strong impulsive moves, where the price rallies or maybe probably the price drops. So when we look at it in terms of ICT concept, when the price is moving up, we say bullish. Right? When the price is pushing down, we say it's a bearish sentiment. Okay. But now in terms of supply and demand, a bullish move is what we call a rally, and a bearish move is what we'll be referring as drops. The consolidation is in terms of demand and supply, we call it the base. Okay. So the key thing now here we are talking about marking the base candle or candles before the move. So you use the recent swing highs or swing lows as a confirmation. All right. So for you to be in a better position to how to identify the supply and demand zones, it's important to understand that we have two types of demand as well as we have two types of supply. The demand zone, it's a place whereby we look for buying momentum. So we have the lower demand zone, all right? So when the price is pushing down, then we see the price consolidating, forming the base. So, and then we see an impulsive move of the price or the price rallies up. So we have the drop, we have the base, and then we have the rally. So we have to wait for the price to come back now to our demand zone. We will mark either maybe probably using the last bearish engulfing or maybe a few candles at the base, at the bottom here, before the price started to rally. So we want to see the price revisit that zone, and then now we take our buy entries. As well, we can have a mid demand zone. This is when we have a trending market. We see the price rally, then we have a base, and then we have a rally, and therefore we anticipate when the price comes back to this mid demand zone, therefore we anticipate the continuation of the rally. However, when you're trading the mid demand zone, it is important to be aware of the premium and discount levels. So if this demand zone that you are looking to buy, if it is in the premium zone, then it will not be a high probability demand zone. So we want a mid demand zone that is in the discounted level, because when we are buying, we buy from discount. Okay, when we are buying, we buy from a discounted level. So this is a mid demand zone. Then we have the supply zone, whereby the supply zone we look for sales. The first setup is whereby we have the top zone for supply, where the price rallies. Then we see the base or consolidation, and then now we see the drop. So we mark maybe the bearish engulfing or a few candlesticks at the base here. Then we wait for the price now to come back to revisit this zone, and therefore we'll be looking for selling opportunities. Okay. Then we have the supply zone, that is the mid zone supply, whereby we have a rally, then we have a base, then we have a drop, and therefore the price creates a mid supply zone here. And at that particular level, what we want to do is to take what we want to do now when the price reaches this level is to look for selling opportunities. remember, like we said on the mid demand zone, even as this one, remember we look to sell in premium. All right. So if this demand zone, mid supply zone is not in the premium level, then it will not be a high probability setup. Okay. So with this in mind, therefore, it becomes very easy for you to now, all it simplifies you going to the charts and looking at these demand and supply zone, because now it forms quite some basis of understanding in terms of looking at the supply and the demand zone. So the key thing now, after that, identifying the zone, very easy to identify the zone. But now, drawing the supply zone, it is very important. Remember, here we are drawing the supply zone and the demand zone, and also we are factoring. All right. Also, we are factoring how you can be able to minimize the risk, because when you're trading the supply and demand, especially for the major currencies, we usually talk about having maximum risk of about 20 pips, or maybe probably 20 to 25 pips is good. But when you're trading the JPYs, they're a bit volatile. You can use maybe a risk to, you can use maybe a stop loss of about 25 to 30 pips. Okay. And when you're trading gold, because you know it is more volatile, therefore you can be able to use maybe probably 50 pips stop. Okay. So it depends on the pair that you're trading. So how do we draw the supply zones? So the first thing you look at is you identify the last bullish candle before a sharp drop. Okay. Then you draw from the open to the wick. You draw from the open to the wick. Then you extend the zone into the future for retests. All right. Because these zones, once we draw them, we wait for the price to retest. Then during the demand zone, it is the opposite. We identify the last bearish candle before a strong rally, then draw from the open to the wick, then extend the zones for possible entries. All right. So remember, when we talk about the order blocks, maybe a bullish order block, we usually identify the last bearish candle. We mark from week to week. But for the demand zone, we are identifying the last bearish candle, and then we draw from the open to the wick. All right. From the open to the wick. The same case with the supply zone. So when we are drawing the supply zone, is kind of related with the bearish order blocks. So for the bearish order block, we usually identify the last bullish candle. We mark from week to week. But now for the supply zone, we are identifying the last bullish candle, marking from open to the week. All right, marking from open to the week. So once you mark those particular candles, then you need to now be in a position to know how to trade the supply zone and the demand zone. So for the supply zone, how to trade it? Once you have marked the supply zone, you have to wait for the price to return to the zone. And once the price returns to the zone, then you can maybe probably add some more confirmation, because remember, when you're trading, your setup should give you at least two. You should have a confluence. That means you should have at least at least two or three confirmations. All right. So then it makes sense for you now to look for bearish confirmation, e.g., engulfing patterns, or maybe pin bars. That is the bearish pin bar. Then you enter with stops above the zone. All right. You enter the trade with stop loss above the zone. Remember your stop loss, like I have defined for major currency pairs, 20 to 25 pips stop loss. For JPYs, maybe probably 25 to 30 pips, because they are slightly volatile, especially GJ. Then for gold, you're talking about 50 pips. So then you need to set your target at the next demand area. Okay, at the next demand area. So when you're talking about the demand zones, it is important to understand how to trade the demand zones. So you wait for the price to touch the demand zone. You look for bullish signal, e.g., pin bars, structure shift, or maybe change of character. Then you enter with stops below the zone. and then you set your target at the next supply level. Remember, just like maybe probably the supports and resistance, because again the demand zones and the supply zones are kind of related with supports and resistance, only that now the trading rules are a bit different, or the entry rules are a bit different. When a demand zone is broken, it becomes a supply zone, and when a supply zone is broken, it becomes a demand zone. Just like when a support level is broken, becomes a resistance. When the resistance level is broken, becomes a support level. Okay. So, just going to give you some few tips for effective trading the zones, the supply and demand zones, before we go to the charts to look at a few examples. So you need to use higher time frames to find the zones. Then now you go down to the lower time frames to look for maybe structure shift or maybe probably change of character. Um, and also to minimize the risk. Then you need to avoid trading every touch, right? Don't be a person who is trading every touch. Wait for confirmations like the market structure shift, change of character, etc., etc. So combine the zones with market structure or trend so that you can have high probability demand and supply zone. So, final thoughts before we go to the charts. Mastering the supply and demand gives you a powerful edge. So you also need to practice identifying the zones on historical charts. That is what we call backtesting and refining your strategy. It will really help you in terms of backtesting and refining your strategy. All right. So with that, allow me to let's now go to the charts so that we can look at a few examples in terms of how to draw or identify the demand and supply zone, right? We are going to look at identifying and drawing them, and also how we are able to take positions based on that. Okay. So let's go to the charts. So this is the Euro USD chart, and actually recently we had a mid. It gave us a very nice mid supply zone, which was activated during the NFP. So as you see this particular trend, the price is pushing up. Then we see the rally, then the base. We see another rally, then we see the base, and then now we see the price push rally up. Then now we see the base, and then now this drop was due to the NFP, the July 3rd NFP that happened on July 3rd. It was on a Thursday, and with this one now from the 4-hour time frame, you can just mark the zone. Remember, we have said how to mark the mid demand zone. So this is a mid demand zone. So how to mark a mid demand zone? We identify the candle, all right? So the bearish candle before the bullish move, and we mark from the open of that candle and then to the top of the wick, and then we extend these for possible retest. So what we have done, we have been able to identify the trend. So we're in an uptrend. We see the price pushing up or rally, then base, rally, base, all right? Rally, base, then drop. So this now gives us what you're calling the mid demand zone, because you're in the middle of a trend, right? So, and when you look at this particular pair, this is Euro USD, when you look at the number of pips here, it's about 22. So it falls within our risk parameter of between 20 to 25 pips. However, you can also be able to go to the lower time frames, like the 1-hour time frame, and you're able to minimize your risk again using the 1-hour time frame candle. So this is the sell candle here. So you mark from the opening of that candle and then to the close of this particular candle, like that. And then now you're able to minimize your risk. So there you have a very nice setup of about 16 pips risk. And like we said, you have this is a long position from the mid this mid demand zone, you have your stop loss slightly maybe 1 to 2 pips below the zone there, and then you are targeting these particular maybe highs around this particular level, the liquidity levels there, and also taking note in terms of taking partials. All right, you need to take partials. Taking partials is very important. So we are targeting the price to come to this liquidity zone. Here we have the liquidity levels. That is the highs that the price had created here. So what we are looking at now is the price pushing up all the way to this target. When you look at the risk to reward ratio, it's about 1:5. So like we said, these demand levels, or these the demand and supply level really gives you very nice setups or in terms of risk to reward, high risk to reward ratio. So of course, when the price reaches a half of your target now, with this one is a risk to reward ratio of 1:2.5. You have to take partials and put your stop loss at break even so that you can mitigate the risk. Okay, so then let's look at another example, maybe probably a supply zone. All right, so we go to the 4-hour time frame. So I like identifying these zones from the 4-hour time frame, because so that now when I go to the lower time frames, I'm basically going to minimize my risk. Right, I'm going to the lower time frames to be able to minimize my risk. So let's look at it that way. So we see some examples. All right, so we have to shift the market so that we can be able to check what the market is really doing, and then now we are able to identify, to expand out. Now, once we zoom it in, we are able to see a bigger level, and then now we are able to expand in, so that now we can be able to um, look at so that now we can be able to draw now the zones. All right. So so around this particular level, right, around this particular area, we can be able to see the price. We can be able to identify a demand level here. All right, so a supply zone here. All right, so we see the price drop. Right, we see this drop, then we see the base, then we see the price drop. Right, so now we mark this last candle from the week and to the opening of that last bearish candle. Remember, this is supply zone, so we are marking the last the last bullish candle. So remember, here we are marking from open, right, the open of this particular candlestick that is here, all the way to the wick of that particular candlesticks. Right, so then we have it like that, and we extend. Okay, we extend for future retest. So as you can see, this one, the price took a bit of some days before coming to this particular level, and the moment the price came to this level, we have now our entry. Okay, we have our entry. So when you look at the risk here is about 26 pips. So what we can do, maybe probably go to the lower time frames, like the 1-hour time frame, whereby we are able to minimize that risk. Right, so let me just go to the 4-hour time frame so that I can see where we are. So this is around December 16th. All right, so let's go to the 1-hour time frame. Now we look at December 16th. All right, we look at December 16th. So this is it. This is it. All right. So when we come to this particular level, so what we look at is now we want to this is the zone. So now we can minimize now the risk using the 1-hour time frame. So we mark using that 1-hour candle like that from the open to the wick, and then now we wait for the price. All right, we wait for the price to come and retest the zone. And here we have this is the perfect entry now, because at this particular point we see a change of character. All right, we see a change of character here when the price dropped below this zone, and then now pushed up again to the demand zone, and then now we have our entry. So if you look at that particular entry, so let's go to the 4-hour time frame so that we can be able to see how far the price went. So meaning that now we can have our entry. This is a supply zone. So we can have our sell setup like that. Okay, so our stop loss needs to be slightly above the zone, maybe 1 to 2 pips, right? So then remember we are targeting maybe probably this level where the price maybe probably reached into the next demand zone. So if you are selling from a supply level, then we want to target the next demand zone. We want to target the next the demand zone. So, and as you look here, this is a demand zone. So we have this bearish candle before the push up. So this is a demand zone. We mark from the opening of that candlestick and to the wick of that candlestick. And you can see the price dropped all the way to this particular level, right? To the next demand zone. When you look at the number of the risk to reward ratio here, we are talking about 1:13, right? You are risking 1 to make 13. So quite a high risk to reward ratio there, which you need for you to be profitable. Okay, so we can extend this, and you see how the price keeps on respecting this level of supply. So if you take your buy setup here again from this particular zone, if you take your buy setup here, so let's see the risk here. It's about it's quite a big risk. What you can be able to do is if you're going to take risk, especially when we have this candle with a wick, I usually look at the mean threshold of this when we have a big wick here. And now I will position myself for a long position here, and my stop loss will be slightly below the mean threshold, right? Mitigating the risk. And then now I will be targeting the next the supply level that we have around that particular point. And that gives you again another risk to reward ratio of 1:10, right? A risk to reward ratio of about 1:10. Okay. So, ladies and gentlemen, as you can see, it's quite really very nice trading strategy. If you look again here, also we have this, right? You have this. So we have the drop, we have the base, then we have the drop, then we have the price coming to this particular point. So this is a mid supply zone. Okay. So we go to the 1 hour time frame maybe to minimize the risk. So we are going to around, sorry for that. Let me return that there. So we are going there to minimize the risk, right? So you can see here, that is the 1 hour time frame. So we can use, for this case, when we have a candlestick that has a wick here, which is not really clear, like looks like a doji, what we do is we minimize the risk to that particular level. So we have the first that we use those two candlesticks, and you can see the price coming and touching that level. Then we see the price revisiting almost the same level again, and we have a very nice drop. Okay, we have a very nice drop. So again, that's a very good setup. You could have gotten around that particular level, which is a short position or a sell position, and you have it like that. You have your stop loss slightly above the zone, maybe 1 to 2 pips. Then now maybe probably targeting this particular level here, because this is more of a supply level. It's more of a demand level around that particular point, even though it's not clear. But you can also still target. Sorry about that. So let me draw it well. You can also still target these particular liquidity levels here, all right? Or maybe you can have it at this particular level. But initially, you see the price pushes down all the way to this TP here, and that gives you a risk to reward ratio of 1:7.38. Okay, so you can see these are three setups, right? These are three setups almost in the same pair. So we have the first setup here, we have the second setup here for the sell, and we buy. Once the TP is it for sell, we still jump in for buys because these are demand zone and it's being tested for the first time. So it's very high probability. Okay. So, uh, maybe the most commonly asked question is which is the best strategy for one to trade? Which is the best trading style for one to trade when using the supply and demand? Okay, because we have scalpers, we have day traders, we have swing traders. So this strategy is best suited for swing traders. It is very effective for swing traders because, as you can see, it's holding the trade maybe for a couple of weeks or couple of days. Okay, so it is ideal to identify the zones from the forward time frame, or maybe probably the daily zone, which offers clean structure and strong institutional footprint and high risk to reward ratio setup. So then you can go to the lower time frames, like I've shown you, to minimize the risks, and then you have your good setup, high quality setup, or what we call A plus setup. So this strategy is vital because it reflects on how real buyers and sellers move the market, and it is best suited for swing traders and maybe day traders as well. And even though it can be adopted for any style with proper execution, but I would request using it for swing trading and maybe probably day trading. Okay. So remember, success comes from mastering zone identification, how to draw them, how to take the entry, being patient to wait for the market to come to your level, and also understanding the market structure. So with that, ladies and gentlemen, the ball now is on your court. I want you to take some time, go to the chart, practice identifying them and drawing them, and now start also putting those trades in the demonstration account. If it's your first time to trade these supply and demand, and yeah, make sure to comment in this video. Make sure to like, to share, and subscribe if you have not subscribed to my channel, because I always share nuggets, information that is going to help you in terms of improving your strategy, so you don't want to miss out. Ensure you subscribe and turn on notification. So until then, see you in the next episode.